Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He began his career at Bear Stearns and Company. Later, he co-founded a multi-billion-dollar hedge fund in Santa Monica, California. Since then, since he retired as a hedge fund manager, he founded Felder Investment Research, and he writes the investment research newsletter, The Felder Report. He also hosts the Super Investors podcast and the Art of Worldly Wisdom podcast. Say that 3 times fast. Jesse Felder, thank you for joining me.
Hey, good to be back with you, Jason. Thanks for having me.
So, Jesse, we're recording this interview on Friday, April 14th, 2023. I want to get your thoughts on all the things that are going on in the U.S. economy right now with the Fed's balance sheet, interest rates. But what do you think are the things in the U.S. economy that you're most worried about right now?
I think the thing is to be most worried about are maybe the things that we haven't seen yet. It's kind of the known unknowns, right? We've seen such a rapid tightening of monetary policy, a rapid rise in interest rates. And because the Fed kept rates so low for so long, they encouraged a buildup of just fragility in the system, right? So many things like we saw with Silicon Valley Bank, with the pension funds in the UK, just so many different people in different areas of the economy assumed interest rates were going to stay low forever, and that was actually the sentiment that you saw on the cover of The Economist, the cover of Business Week magazine. Is inflation dead? Before this inflation pickup in the last couple of years, everybody assumed we were never going to see inflation ever again. Interest rates were going to stay on the floor forever. And that encouraged a lot of bad behavior on the part of investors and people in the financial system and lenders and what have you. So I think, we're only beginning to see the problems, the fragility in the financial system that has built up as a result of too low interest rates for too long a period of time. And so, with inflation, the inflation report came out this week, showing that, there's still plenty of inflation in the system, and especially wage growth is still very strong. It doesn't look like inflation's coming back down to 2 anytime soon. And so that's why you have Fed heads still talking about increase, more rate hikes. They're probably going to raise another 25 basis points in May. And then they need to hold rates, they say they need to hold rates high for a prolonged period of time to really kind of wring the inflation out of the system if they're able to do that. Now, if the longer they kind of persist in this relatively hawkish policy, the more strain it's going to put on these fragilities, the unknown fragilities in the financial system, and the more we're going to see problems crop up like Silicon Valley Bank and the pension system, problems in the UK.
I think what you described earlier is the Austrian theory of the business cycle, the artificial boom and bust. You had the malinvestment. You had all this artificially cheap currency and credit from the Federal Reserve Bank and other central banks. They expanded their balance sheet enormously since 2008. And for examples of malinvestment and waste, when there were cheaper interest rates here in the DC metro area, especially downtown in DC, there was just tons and tons of teardowns. I mean, there was literally right next to the Washington Nationals baseball stadium, Nats Park. There was literally, I think, in the air, in the sky, if you took a photo of it, and you could go back and look at this on Google, I think there was dozens of construction cranes. So there was just tear down because of cheap interest rates, tearing down these old buildings and building, brand new mixed use buildings of luxury condos and commercial real estate.
Yeah, you pull forward a ton of demand, right? I mean, I think the best example of this, I think for people to understand is what happened in the oil market. When the Fed initially lowered interest rates and started printing a ton of money in the midst of the great financial crisis 15 years ago, a lot of that easy money from 2008 to 2014-ish went into the frackers who were able to borrow so cheaply and invest so heavily into expanding production and increasing supplies. And then the oil price crashed in 2014, right? Because there was too much supply came online. And so initially that money printing and everything is deflationary, but eventually it becomes inflationary. So part of the deflationary impulse was now we have all these zombie companies in the economy, right? Companies that You think about a company like DoorDash, right? Where they literally, it's not possible for them to turn a profit. It's great for you and I if we, it's very convenient to have food delivered to your front door for a very little cost. But they can only persist in that business model, in that money-losing business model, so long as cheap capital is there to plug their losses every year. When that cheap capital goes away, that business goes away. And you can extrapolate that across a bunch of these zombie companies. And if you have, a big, essentially, death event, for lack of a better term, for these zombies, where they actually finally, die and are buried and put to rest, that can create a supply shock in the economy that would be even more inflationary. So these problems, people think that like lowering interest rates is going to encourage inflation. Originally, it is disinflationary because it creates so much supply, a positive supply shock. Where you have all these companies offering, products and services at money losing, margins. But now with raising interest rates, you're probably going to put a lot of these companies out of business, and you're going to have a negative supply shock where a lot of these products and services go away, and it becomes more costly to do things. So I think, this is, you're right. I mean, Austrian economics has been warning about this, if you've studied it for a long, long time, that these are the lessons of money printing. And, it's a sad situation that we have to relearn them all over again in real time.
I actually wanted to explain to our listeners how things are supposed to work in capitalism. So in capitalism, you're actually supposed to have bankruptcy. It's not supposed to be an evil word. If a company screws up their balance sheet, goes bankrupt, they have too much debt, they make a consumer product or build out too many stores, those assets, the good assets that the company has, are eventually bought by a more disciplined competitor, another company, a new entrant. The bankruptcies are probably initially deflationary, right? So then the person who is more capital disciplined, who didn't do all the malinvestment or all the crazy expansion, borrowing debt, couldn't pay back the debt, is supposed to be able to go and buy those assets for pennies on the dollar. But what these central banks have done, Jesse, it seems they were picking and choosing winners and losers, and they didn't want a lot of these companies to go bankrupt and actually allow capitalism to allow deflation. So then you had these zombie companies, like you were saying. I mean, in the European Union, for example, there were even more zombie companies than in the United States. My friend Daniel Lacalle was writing articles about this for Mises.com prior to 2019, so 2016, 2017, because of the negative interest rate policy the European Central Bank had. They were buying tons of junk bonds, corporate debt, and artificially subsidizing interest rates.
Yeah, and so it's it's a situation in which we're just now feeling the longer term repercussions of the money printing that's been going on, for 15 years. And so I think that we've seen the initial deflationary impulse of the money printing, which you said they suggested they were potentially picking winners and losers, and I would just counter that. They didn't want any losers. They wanted everybody to be a winner. And so the cost of capital, they lowered the cost of capital so low that there was literally no hurdle to starting a business, right? You could, fund all these money losing operations, and investors were interested in them because, it's almost anything looks better than getting 0% in a bank account. And so, with the zero cost of capital, tons of businesses got funded that shouldn't have gotten funded. And so everybody becomes a winner. But now that interest rates have been normalized, a lot of these companies are going to turn into losers. They're going to go out of business. And I do think that it could have significant inflationary effects, just as the supply of a lot of different services goes away, and the competitors to these companies have less competition, right? If as Warren Buffett has said, in a commodity business, you're only as you can only be as smart as your dumbest competitor. Well, a lot of these companies have had really, really dumb competitors in the last 10 years where, look, I'll run a business at a loss just to try and gain market share for a long period of time. Now those guys are going out of business. And so the competition across a number of industries is going to dwindle. And I think we're seeing that now. I think that's one of the reasons why we see profit margins so high, because I think a lot of less, VCs are funding a lot less of these money-losing companies. They're having to batten down the hatches, the companies that still exist. And so competition generally across the economy is narrowing. That's inflationary.
So you mentioned that there's higher labor cost of capital is obviously higher, even for large corporations. Do you expect a mean reversion for profit margins and then also potentially dividend cuts for some of these large cap dividend stocks that a lot of retirees are dependent on for income?
Yeah, I mean, that's to separate that into two questions, really. I think that, yes, we've seen capital gain at labor's expense for decades now, right? And a lot of that was simply due to companies could ship production overseas where it's a lot cheaper. And so pressure on labor costs has been, downward, right? If you can't produce something at X level, then it's going to get offshored, and that pressures labor costs here in the United States. Now that that trend has essentially run its course, globalization, has been in the process of reversing into kind of a deglobalizing trend since the great financial crisis, and it's accelerated since the pandemic, where a lot of companies have realized, okay, wait, just-in-time production, it doesn't work anymore, because if our supply chain is disrupted, we literally have no product to sell. That's not sustainable. We need to reshore production, and we've seen investment in manufacturing in the United States just soar in the last 12 months. That is inflationary, and it puts a great deal of pressure on labor costs, which we're seeing. Right? I mean, I think it was the Atlanta Fed's wage tracker turned significantly higher again last month, even though inflation, some inflation pressures appear to be abating. Wages are not. Wages are still very, very strong. 6.5% or so year over year, which suggests, that's going to keep inflationary pressures in the rest of the economy elevated. And I think that just demographically, with an aging societies, you have a smaller workforce as a share of the overall population. In every developed country, and even China's getting there, and so that puts pressure on wages as well. The Great Demographic Reversal is a book that came out about a year ago, and it details that trend that is essentially suggests that wage pressure on wages is going to remain elevated, and this trend in capital benefiting at the expense of labor is probably reversing, and it's probably for the next 10, 20 years, corporate profits are going to be facing the headwind of rising labor costs. So I talked so much, I forgot the other half of the question. Oh, dividend stocks.
Cuts, yeah.
I think the other thing, this is something I wrote about on my blog this week. There's so many companies, in the past 10 years used cheap capital, right? They could borrow so cheaply. I mean, Apple, has its lowest cash position in, whatever it is, 10 years, because they have, spent so much money on buybacks and borrowed a ton of money to fund buybacks too. And now they're probably not the best example of this. I use McDonald's, Caterpillar, Boeing, and 3M as my 4 examples of companies that together, all 4 of these companies borrowed a net $100 billion to fund buybacks over the last, since 2012, 13, over the last decade. That's a net $100 billion of new debt on the balance sheet. That was fine, not a big deal. It made a great sense maybe to do that equity for debt swap when interest rates were super low. Now when interest rates aren't low anymore, interest expense on all that debt's going to go up. And it's going to start eating into operating margin and, operating profits pretty significantly. And, that pinches those companies' abilities to pay dividends and do whatever else, not to mention what labor costs are also going to do, to companies like those. So I do think, profitability is generally facing headwinds of higher interest rates, higher labor costs. That's going to put pressure on companies to be able to continue to raise dividends in the way they have.
I haven't seen any wide-scale dividend cuts in any particular industries yet, except for the real estate investment trust. So that seems to be the big red flags right now. Now, not all real estate investment trusts are as bad, but some of them, there's a lot of red flags there.
Yeah, real estate is usually one of the leading sectors of the economy because it's so interest rate sensitive, right? So raise rates, it affects real estate first because it's such a highly leveraged industry. So I think probably those stocks are really just the canary in the coal mine for the larger economy that they're so highly leveraged that they feel it quicker. But a lot of these other companies are also basically in the same boat. They're maybe not quite as leveraged, so it's not going to happen as dramatically. But when it comes around to finance a lot of that corporate debt, that's going to create higher interest expenses, and that's going to eat into profits and make it difficult for these companies. I really think that the trend of taking on new debt to buy back stock is especially going to come back to hurt these companies because they didn't invest in property, plant, and equipment and things that were going to improve productivity and increase sales. It was purely just financial engineering, which worked when interest rates are low, is actually doesn't work at all when interest rates are higher.
Yeah, I agree. It's actually going to be similar to the reverse wealth effect. So these higher interest rates are actually going to cripple the company's free cash flow. And then the company's going to be paying a lot more in interest expense. So they're going to have to cut back on all the things you said, either share buybacks with free cash flow, dividends, investing in new products or services with research and development. So all these things, potentially the company's going to have to, in order to protect its balance sheet, they're going to have to spend a lot more on interest expense, paying that off and paying down debt than they anticipated.
Yeah, it's just going to come back. I mean, just like leverage, in any individual's life. I mean, you want to take on a bunch of credit card debt to buy a bunch of stuff, that's going to come back to bite you in the butt. And unless you can, somehow generate a lot of income in a short period of time. But in the case of these companies, these are old, blue chip companies whose businesses are relatively stable. And in fact, their sales growth has, if you look at it, even in nominal terms, had been declining, for a period of years, and in real terms is nothing to write home about by any stretch. So, it's a shame. It's essentially, a very short-term thinking. Let's inflate the stock price in the short run to enrich, top executives, and so they can offload their options and things at elevated prices. But it has long-term costs for shareholders who didn't follow the lead of those executives and offload shares while the companies were buying so heavily.
And for commercial real estate, this artificially cheap capital, it takes even longer because these projects are very expensive and slow moving. So there's been, just as I talked about with my DC example, but there's tons of other of these with artificially cheap interest rates. If you're a commercial real estate developer, you want to go and buy that land, that strip mall or residential houses, and you want to tear it down and you want to either build McMansions or you want to go build these large commercial real estate office spaces, these trophy spaces that you can charge much higher rents on. Well, it looks like the math for these, and we were discussing this before we started recording, Jesse, that there's just tons and tons of different headwinds for commercial real estate. So I don't know if it's going to be 3 months, 6 months, but it looks like this commercial real estate bust is going to be the worst one in decades.
It could be. I'm no expert in commercial real estate financing, but I will say the area to be concerned about right now, I think, is office space, just because with this work from home trend, which is honestly in the process of reversing. People are going back to the office, but I don't think they're ever going to go back in the way that they did before. And so there's a lot of extra office space. And so I think the way to think about this, and Odd Lots did an interesting podcast on the topic recently, is that you have to look at the leases of the individual companies, and if they have a 5-year lease with a AAA rated tenant, and CPI, able to raise lease rated, rate of CPI, it's not too much to worry about. That tenant's not going to, be a problem. But if you have a building that's only 50% occupied and your leases, are going to expire in the next year or two, and then you have a bunch of debt on that building, that there's going to be a problem there, right? Because maybe your debt, you got it, I don't know, 5% or something like that, and now you're going to be looking at 8 to 10, and that lender is not even going to want to lend to you the same amount of money as you've already borrowed because you don't have the cash flow to support it because you have so many vacancies. And so I think that's there's going to be situations like that, but because there are a lot of long-term leases out there. There's a lot of AAA tenants. It's really hard to know how it plays out. Now, I think those regional banks are the ones who've been making all these loans, and they do not want to foreclose on these types of properties because they don't know how to manage an office building. They don't want to manage an office building. But that I think that's where the problem is going to be. And it's been interesting to me to see individual investors just piling into these financial ETFs and the regional bank ETF KRE when you have this potential commercial real estate problem building on the balance sheet. You have a lot of them have already been hurt by the value of all their loans and things, the asset side of their portfolio, and just the net interest margins. I mean, right? We might not have see a lot more Silicon Valley banks, but I mean, the history of just the interest rate cycle is Fed raises rates, net interest margins collapse. Profitability is terrible for these companies for a time until the Fed cuts rates dramatically again, and then they can start making net interest margins again. But also in that process, what forces the Fed to cut rates again? It's usually a recession, and so you see defaults and all these other things. So now I don't think is the time to go anywhere near a lot of these regional banks. And as an investor, I don't have any interest in them.
Yeah, I've been watching interviews on the Blockworks macro channel from some of these hedge fund managers that are short commercial real estate and some of the derivatives of commercial real estate mortgage-backed securities, some of the other synthetic stuff. They're just talking about how these regional banks need to raise a lot of capital. But in this market, I don't know how they can raise a bunch of equity capital if they have all these losses and they're mark-to-market. They're doing mark-to-market on their losses. I don't know who's going to go and fund a lot of their equity capital to fix their balance sheet.
Well, look what happened to Silicon Valley Bank as soon as they tried to raise equity, right? They announced they're raising equity, and literally 24 hours later, they're taken over, by the feds and proclaimed insolvent. And so I think that is, the problem is that as soon as a company says we need to raise equity, investors realize, wait, that means they're insolvent without it. And so we need to get our money out of that bank. And so it's a real catch-22 for these regional banks right now. And I mean, not just the interest rate, the problem, the lending long, borrowing short problem like Silicon Valley Bank had, but now with the potential of recession and defaults and the commercial real estate problem, that regional banking sector has a lot of risk and I think very little potential reward.
So the regional banks are going to need to keep their depositor interest rates that they pay for new depositors very, very high. But you have a lot of people that have pulled cash out of regional banks, and they've either parked that cash at the larger banks like a JP Morgan or one of those 5 or 6 other large banks, or they're putting that cash into short-term U.S. Treasuries because they can make over 4% yields, quote unquote, risk-free, or into the money market funds. So regional banks are not keeping their depositors or getting new ones that easily either.
Yeah, I think we've seen in the last couple of weeks the amount of money in money market funds has hit record levels. But what is interesting to me is that when you look at the amount of money in money market funds relative to the amount of money in stocks and bonds, it's still minuscule, right? So people think there's been this big shift into money market funds, but it's actually tiny, compared to the total, value of the larger asset markets. And so that tells me there is still a great deal of potential for money to move into money market funds in the months to come. And to me, if I were running a regional bank, that would make me nervous.
Yeah, I just see this as a slow motion train wreck. I don't know the timing, so I don't know if we're going to have problems in the next month or 2 or 3, or it's going to take 6 to 9 months. But if the Fed's going to keep interest rates higher for longer, they're going to raise another 1 or 2 times over the next couple of meetings and keep rates there without lowering. I just see more and more problems for commercial real estate in the regional banks.
Yeah, and I'll just point out from a technical standpoint, you look at like a weekly chart of the Spider Regional Banking ETF, KRE is the symbol, and it formed a very clear head and shoulders top from January 21 to the end of last year, and it broke down below that neckline in March. And classical technical analysis tells you, you measure the top of the head of that pattern to the neckline, and then that tells you how far the price should decline below the neckline, and that gives you a target of about $35 a share. So it tells you that you still have another $7.50 a share to decline from here, which would be about another 20% or so. Just from a technical standpoint, which to me kind of validates a lot of the fundamental concerns that we're talking about.
That's interesting. I'll have my friend who's a chart specialist take a look at that chart, and we'll see if he says the same things that you do on the This Week in Chart show on my YouTube channel over the weekend. But I want to get your thoughts on gold. So gold's relative strength has been pretty strong lately despite CPI. Why do you think gold has been strong lately in kind of a deflationary case scenario or bankruptcy scenario?
Well, I think there could be a variety of reasons, but I think that I've been using a 2018 price analog, which was worked really well. And if you look at, the gold price and the last Fed tightening cycle, Jay Powell's last, tightening cycle through 2018, the gold price bottomed about, 4 to 6 months before the Fed finished tightening and paused, announced that they were done. And so gold, I think, is trying to do the same thing today, right? It bottomed back in the late fall, early winter, which is, and if the Fed is going to pause, a lot of people think the Fed's already done. The Fed's not saying that, but they might raise again in May. And that would be roughly that same time frame where gold bottomed about 6 months ahead of the Fed's pause and potential reversal in monetary policy. Now, you look at the technicals on gold, right? And we've had essentially since 2020, almost a 3-year period of sideways movement in gold, which to me looks like a bullish flag pattern. And if the way classical technical analysis would tell you to look at this is you look at the breakout higher in 2019. Above the previous 2018 highs, and the gold price from 2019 to 2020, and that 1-year move higher went about $700 higher before it formed this kind of bullish flag pattern. So breaking out above the upper trend line, breaking out of this flag pattern would suggest, according to classical technical analysis, that this next leg higher is going to be equal to that previous one. So about a $700 move to the upside is just what technical analysis tells you. But I think, we have seen, it's been fascinating to me to see gold be so strong, really since those October, November lows, and retail interest, just not materialize at all. That's really unusual. It tells me that gold is moving for other reasons, right? Central banks have been heavy buyers over the last 6 months. I mean, record buying by Bank of China and others. And so I think what's going on is gold price is being powered by those kind of central bank buyers and by the potential for the Fed's hawkish campaign to come to an end. Now, once retail buyers do hop on board, it's not hard to see how you could get another $700 move, because that's what powered the gold price in 2019, 2020 was retail buyers and ETFs and these types of things, got excited about owning gold. And I think they'll do so again. I think we're very close to a tipping point in inflation psychology. It's kind of what I wrote about this weekend, and that would drive some real interest in owning gold.
Do you think also part of this is the market sniffing out that the Fed's either not going to be able to keep doing the rate hikes, or they're going to cause bankruptcies in the private sector? And then the Fed's balance sheet, which has been the official balance sheet, at least, has been net declining. You think that that's going to have to end then, and the Fed's going to have to, like it's done since 2008, going to have to come back in and start increasing the balance sheet again?
Well, one of the things that powered gold higher in 19 and 20 was that repo fiasco. And the Fed was trying to normalize the balance sheet, had a problem in repo, and decided they couldn't normalize, right? And this was before the federal government went and spent $5-6 trillion in brand new money in a short period of time. The Fed had to print in order to make that happen. So, gold powered higher after, we realized that the Fed can't normalize the balance sheet because it creates problems in the financial system. And the problem at the time was materialized in repo. What we're seeing, I think, today is the Fed can't normalize the balance sheet. They can't remove all these reserves from the system without causing more problems like Silicon Valley Bank. And what did the Fed do in response to Silicon Valley Bank? They created a whole new lending facility to expand the balance sheet once again, which is another sign, just like repo, that they can't normalize the balance sheet, right? Whenever they try, it causes these fragilities, like we talked about in the very beginning of the interview. These fragilities materialize, and the Fed is forced back into the markets, and so the balance sheet just can't normalize. And I think that's what's driving people into gold, is a realization that the fiscal, the path of fiscal policy is headed towards wider deficits, literally on an inexorable path towards wider deficits. The Fed is going to be forced to monetize those deficits. And when more people come around to this way of thinking, that the gold price is going to really take off.
It seems the Fed is handling things the last couple of months with Silicon Valley Bank and some of the regional banks with that new alphabet soup program very similarly with the wording to the repo crisis, like you said, because initially during the repo crisis, for our listeners not familiar, the Fed said it wasn't quantitative easing, and they said they were just loaning at full par value. But then the loan durations during the repo crisis back in 2019 kept being extended and extended and extended. And then eventually the Fed just added, I think, around $1 trillion to their balance sheet in a couple months. So we may see things play out pretty similarly now. But I interviewed Danielle DiMartino Booth last week, and she's like, this is not QE. The Fed's balance sheet's not expanding. And I was like, well, the Jerome Powell speeches recently remind me very similar, exactly what he said back in the 2019 repo crisis.
Yeah. I don't think it's quantitative easing. I don't see it as that, but it is still expansion of the balance sheet. And I really think the key thing to focus on is you go back 10 years ago. I think it was 2012-ish. I don't hold me to this time frame. But Ben Bernanke was testifying in front of Congress, and a congressperson asked him, said, all this quantitative easing that you call it, QE, isn't this just money printing? And Ben Bernanke's answer was, he said, if this was permanent, then yes, it would be money printing. But because it's not permanent and we're going to normalize the balance sheet, that's what makes it not money printing. So here we are 10 years later, and we're learning, every year, 2019 and this year, that the Fed cannot normalize the balance sheet. It can't happen. And so what does that mean? It means, by Ben Bernanke's own definition, this is money printing. And the Fed is being forced to print money to monetize the rapidly growing pile of debt that is. I mean, we saw statistics this week on the deficit. It's blowing out again in March, and so with all of these trends going on, with the deficit blowing out and all of this stuff, the Fed is going to be forced to reverse course. I mean, and they already have been, right? We saw the balance sheet. They undid essentially half of the balance sheet tightening in a period of weeks. And that tells you, I think, all you need to know is what is the true character of monetary policy. It's monetizing the debt.
Bernanke also wrote an academic research paper, I think back when he was a professor, talking about how if the different central banks coordinated their quantitative easing, balance sheet expansion, money printing, that it wouldn't be inflationary either. So even if their money supply and their balance sheets all expanded because the relative price levels would stay the same, he argued that it wouldn't be inflationary. So, I mean, he had some really radical views.
Yeah, and everybody probably believed him at the time, because initially, like we talked about, money printing was was disinflationary. It wasn't deflationary, but it was disinflationary. And I think, like I talked about, what we saw with the oil price was probably the best example of that. It encourages malinvestment, which initially is disinflationary. Over the longer period, it becomes inflationary.
And I would also say that the majority of the monetary inflation and the cheap currency and credit from 2008 to 2019, the majority of it, the overwhelming majority via the Cantillon effect, it went into asset prices. So whether it was shale oil production, real estate, stocks, bonds. I mean, there's a chart from Yardeni Research showing the central bank balance sheet expansion of the major G7 central banks, and it's almost perfectly correlated with central bank balance sheet expansion from 2008 to 2019 with the S&P 500.
Yeah. Oh, absolutely. And the Fed, I mean, Ben Bernanke told us this in the beginning. They wanted to create a wealth effect by boosting asset prices, by narrowing spreads, by doing all these things. So they were targeting asset prices to try and make people feel wealthier so they'd go spend more. And to think that, I mean, it's really tough to kind of look at these things, right, over time and realize, rather than kind of taking our medicine and allowing a recession, allowing a debt crisis, whatever needed to happen in order to get a healthy reset to where the economy could begin to grow again on a healthy level, rather than doing that, it was just kicking the can down the road. And in fact, my friend Jim Bruce, who made a documentary called Money for Nothing about the Fed, he interviewed Janet Yellen about this in the wake of the great financial crisis. And she said, we need to somehow find a way to grow the economy without having to blow bubbles to do it. And I think the Fed is very aware that, there are long-term costs to trying to use the asset markets to manipulate the economy, but they are just, there's no will, at the Fed to allow for the things that would really bring inflation back down and allow the economy to reset, allow a lot of these zombie companies to go out of business and create kind of a healthier foundation. Because it's very, very painful in the short run. It's understandable, right? Paul Volcker needed to have security, right? Secret Service, right? I think he was assigned his own Secret Service unit to protect him when he was raising interest rates in the early 80s, because it's not popular and it's extremely difficult, and most people don't have the courage to actually do what it takes, do the right thing for the economy in the long run. Now, when you look back and go, okay, well, what Paul Volcker did created a couple of years of really serious pain, but it set the stage for 20 years of very, very strong, healthy economic growth, right? And I guess that's how you have to sell it. But there's really nobody listening right now.
And Paul Volcker almost created a mutiny on Wall Street with those interest rate hikes. The other major problem to this, Jesse, is spending in DC from both political parties. There might be a couple people in either party is actually talking about spending cuts. The majority of politicians in both political parties, they're talking about new spending programs and new ways to fund it. So it's all about spending increases and not about being efficient or cutting back on spending. And then if DC wants to spend more, Jesse, I'm trying to figure out who would be buying those treasuries, because if DC needs to expand the deficit and sell more treasuries, if China, Japan, and Germany, who are running the trade surpluses in the past and used to be the large net purchasers of U.S. treasuries, and they're not buying, who do you think would buy the treasuries then?
Yeah, I mean, it's astounding to me. This budget report, the federal budget deficit, the report of the budget came out this last week, and I saw literally zero. I was waiting to see Bloomberg pick it up, Wall Street Journal, somebody, I could, and I read these things, these websites and papers every single day, essentially cover to cover. And I saw nothing about it. The only, I think, outlet was Market Watch, published a very short piece on it. And the deficit is blowing out. I mean, the reason why I was expecting to see more is because, in the first 6 months of the fiscal year, I think spending's up 13% and revenues are down 3%. And so we saw the deficit to GDP, was, 20% or something during the pandemic, something ridiculous. Only time we've seen that is during World War II. It narrowed to almost 5% last year, but it's already, widening again to 7, almost 7% of GDP, which is just astounding to me. I think in March, we saw, these trends accelerate dramatically in March, where, I think we saw spending for the month of March was up 30% plus year over year. I mean, it's literally getting to, and a lot of that is just interest expense, right? So it's getting to the point where the deficit, I think, is getting very, very problematic. I think we'd have to cut total spending by 25% to balance the budget at this point. And there's just that's not possible. I don't even think it'd be possible to cut spending by 5% at this point. It's just because there's no political will to do that.
On the news, they're fighting about all the lack of Social Security, and they're talking about how to fund it now. But doesn't that mean the Fed's going to have to cover it, or they're going to have to raise taxes?
Yeah. I mean, and if you think about raising taxes, right, there's no political will for that either, right? Democrats are trying to raise taxes on the wealthy. I think probably the lowest hanging fruit in that regard is just to undo the Trump corporate tax cuts, which, right, I mean, if you're talking about corporate profits and they're already suffering rising labor costs, rising interest expenses, if you go in and just undo those tax cuts and raise corporate taxes, essentially, I think that's probably the lowest hanging fruit for tax cuts, because it's or for tax raises. But that's probably the most, I mean, not probably, it's definitely the most problematic.
I'd say that's bearish for I'd say it's bearish for the stock market. Then I'd say the stock market then will either be in a bear market or it will go sideways, because it sounds like all these input costs are going to go up. Profit margins are definitely going to get squeezed in.
And I think, I mean, that's probably the only answer. I mean, spending cuts are just not going to happen, because there's people will not vote for politicians who are trying to campaign on a platform of cutting spending, especially after the experience of the pandemic, when we sent checks out to people. People have become accustomed to, fiscal largesse and getting checks in the mail and all this kind of stuff. And so, once people get, accustomed to that stuff, they're not going to move away from it. So the only thing that I think, is possible is raising taxes, and they're going to have to. I mean, I think the market's going to force them to raise taxes, because if you get a recession and interest rates don't come down, right, or you don't get enough buyers for all the debt that's being issued, and interest rates go up in the middle of a recession, right, then you have a very clear message to both Washington and the Fed that you have a major problem on your hands. And so then you start talking about raising taxes and yield curve control, right? You need a fiscal and a monetary response to that type of situation.
And that means that's similar to Bank of Japan. That means then the Fed can't reduce its balance sheet anymore, because I honestly, I'm trying to figure out who would actually buy all those treasuries. If the DC needs to keep spending and they want to sell more treasuries, they need to fund their budget deficits. I mean, it's either the Fed's going to buy it and do a 180 and expand their balance sheet, or maybe they change the law so the large U.S. banks like JP Morgan and those guys, they have to hold 30% or 40% treasuries, similar to wartime or post-World War II, something like that.
Yeah, I mean, they could absolutely do something like that, where you say, you got to buy a bunch of treasuries, and don't worry, you're not going to take losses on those like Silicon Valley Bank did, because we're going to cap yields at 3% or whatever it is. But yeah, they'd have to do something, along those lines. If they were allowed to, to set market interest rates, right? I mean, pension funds would love to see 5, 6, 7%, 8% treasury yields, right? You would actually, find some demand for treasuries, at 6, 7, 8%. But what would that do to the deficit, right? I mean, if we're already seeing the deficit blast higher with interest rates at 4, right? You let interest rates go to 7, and you're talking about a debt spiral.
Well, do you think pension funds have a lot of cash on the sidelines? I mean, from listening to some of these pension fund consultants that were hired to go in there and look at the accounting books and the investments of the pension funds, it looks like there's a lot of weird exotic leverage trades that were based on zero interest rate policy So like kind of risk parity, or a lot of investments from these pension funds in commercial real estate and other things. I think there's actually going to be a lot of losses, Jesse, based on the interest rate hikes that people weren't expecting. So like if the pension funds had not done those crazy trades, yeah, they would have cash, and yeah, they could go buy those treasuries and make an extra 5 or 6% if interest rates were allowed to go higher. But I think the last 15-year pension fund behavior, because of cheap rates, I think they went and gave capital to hedge fund managers and commercial real estate developers, angel investors, venture capitalists. And I think there's a lot of unrealized losses that these pension funds are sitting on over the next couple of years.
I mean, potentially right now, right? Private equity and things are not really showing losses, which is kind of silly. But when you look at I mean, there was an interesting article in the Wall Street Journal about this a week or two ago, where they talked to the head of CalPERS, the largest pension in the country. And in the 1960s, CalPERS had 100% of its, California government pension. They had 100% of their assets invested in treasuries, right? After 1965 or whatever, they started diversifying into other things. And in the last 10 or 20 years, treasuries fell to, 15% of assets or something. So, and they got into, you're right, a lot of private equity and venture capital, but a lot of that's just essentially in index funds. A lot of it's just in the S&P 500 too. So, and that's what they were saying in this article, is that with interest rates at 4 or 5%, and they have a 7%, target, they're saying, well, this makes a lot more sense to take, instead of 15%, let's maybe have 20, 25% in treasuries if we can get 4 or 5%. And, if you could get, like I said, if you could get 5, 6, 7%, they'd say, shoot, let's put 50% into the treasury market. But you're right. Where does that money come from? It's not cash on the sidelines and a pension fund. That's money that's invested in the S&P 500. That's money that's invested in private equity, in venture capital, and these types of things. And so to try and get that money back out would create major losses, and risk assets would be very problematic. So that's the other problem with allowing interest rates to go up and allow market forces to kind of price treasuries. So, it's an interesting situation for sure.
So from what we've talked about over the last 40 or something minutes, it sounds like you expect a lot more volatility in asset prices, kind of a roller coaster based on Fed and central bank policy and U.S. government spending, that you don't expect necessarily a market crash or a crazy bear market rally, or a new type of bull market. Would you say that the probability is pretty high of kind of a sideways market with a lot of asset price volatility?
I don't think so. I think this is a bear market rally we've seen since last October. And it's been, actually not even a super strong one. Historically, it's actually been kind of a normal bear market rally. I think that what drove the first half of the bear market was the normalization of monetary policy, right? We had a huge stock market blow off as, the result of the Fed printing $5-6 trillion of new money and pumping it into the markets, right? That created a huge blow off. It also created, I think, a huge bubble in earnings. And I think we're in the early stages of that earnings bubble unwinding, and also that speculative mania in the asset markets unwinding. So I think this next second stage of the bear market in equities is going to be a real serious earnings decline and recession. And the market's not even pricing recession right now, the stock market. If we get a recession, stock market could go down, S&P 500 could go down 1,000 points pretty easily. 25% decline would not be anything out of the ordinary for a typical bear market. And so, I do think that we're very near the end of this bear market rally, and that into the summer, fall months, we could see stocks head back down, test their lows, and break down to new lows.
And I think a lot of people out there think that there could be a big stock market rally if the Fed starts cutting interest rates. But we know from the past, where there was a recession or depression, and then the Fed was reactive to it, that it would take at least 6, 9, sometimes even 12 months before stocks started to gain positive traction again, because these companies are still dealing, as you described during the interview, with all these different problems. Cost of capital is higher, wage increases, the consumer doesn't have as much discretionary spending, maybe their leases for commercial real estate are higher. So all these problems sound like headwinds to me, not bullish things for stocks. Even if the Fed were to actually do a 180 and start cutting interest rates, that would not, there would be a lag effect to the Fed cutting interest rates.
Well, so investors have learned the lesson over the last, I don't know, however long, that when the Fed is engaging in QE or lowering interest rates, it's bullish for asset prices. But if you look at major bear markets, right, the majority, the steepest declines, price declines in bear markets happen when the Fed is actually cutting interest rates, right? The worst part of the bear market doesn't even happen until the Fed starts to cut. And why is that? Because what makes the Fed cut interest rates? The Fed's not going to cut interest rates today with inflation such a problem unless there's a really big, I mean, right? They're not even talking about stopping in rate increases right now as a result of a banking crisis, right? So what is it going to take for the Fed to cut rates? It's going to take some very, very bad economic news. And very, very bad economic news is not bullish for the stock market. So you look back at the 2008-9 bear market in stocks, 2001-2 bear market in stocks, and once the Fed starts cutting interest rates, that's when the stock market is actually vulnerable to its steepest declines.
As we wrap up the interview here, I want to get your thoughts on insider buying in industries, because I know you track this for your newsletter, the Felder Report. So are there actually any industries now where senior executives are saying, my stock looks pretty cheap, I think something looks reasonably priced, our companies have good profit margins or free cash flow? Are there any industries that actually where there's pretty large net insider buying lately?
Well, when you look at insider buying in aggregate, over this whole 6-month period when stocks have been trying to bottom, we've never seen insider buying in aggregate raised to a level that would be indicative of a significant bottom for stock prices. Typically, over like a 12-week period, we'll see about $2 billion worth of insider buying. We've gotten nowhere close to that over the last 6 months, which tells me insiders don't think this is a major bottom. Now, the other side of that is I was looking very closely during, in the month of March to see if regional bank insiders would step in, any bank insiders for that matter, would step in and buy stock, right? Because the bank stocks have gotten hammered. And we did see a little flurry of insider buying at a handful of banks, but nothing significant, nothing that I would consider to be a very high powered signal in terms of insider buying, which tells me that if insiders aren't buying into these regional banks, I don't want to touch them. The only area where I have seen some interesting insider buying over the last 6 months or so is in the energy sector. And this has been true really since late 2020, fall of 2020, is when energy insiders started to buy really heavily in their own stocks. And so we've seen not super heavy buying in energy, but I would call it significant. So, the last month we've seen insiders in Devon Energy step in. There's been some cluster buying there, CEO and I think chief operating officer, a couple of directors. Comstock Resources is another one that I follow. Both companies heavily in natural gas production. Where we're seeing some insider buying, and you actually see the same thing in the Commitment of Traders report, right, where you saw commercial hedgers in the oil price literally eliminate all of their net short position, which is very, very rare. You only see this at times when the oil price is putting in a major bottom. And so the Commitment of Traders report is essentially commercial oil hedgers, and they're saying that they are very, very bullish on oil prices over the next 6 months to a year. So I think it's the only area that I've seen anything significant in the past 6 months or so.
It makes sense because we were getting pretty close a couple of weeks ago to on the West Texas intermediate oil price around 67. That was getting close to marginal production cost. And if you're short oil futures contracts, and then all of a sudden you see on a Sunday night, you see the Saudis or OPEC are announcing a large scale production cut, I mean, you're going to get squeezed.
Oh, yeah. Yeah, there's an interesting dynamic there between Saudis and what the White House is doing with the SPR, and there's some jockeying back and forth there. But I do think if you just to look at bring in kind of some technical analysis here, you look at a long-term chart of the oil price. I'm talking about go back to that 2008 price high. And you had a long downtrend from 2008 to when oil prices went negative in 2020. And you can just draw a parallel channel for that 12-year period. Last year, with the start of the Ukraine war, we saw the oil price break out of that channel, and it's come back to test that breakout level, which is an incredibly bullish pattern over on a very long-term time frame. It tells me that oil prices have that this long consolidation period is over, and we're in a new super cycle for oil prices, and they're probably headed much higher over the next several years.
And we were talking before we started recording that I was an oil analyst for my day job years ago, and there's just been a lack of oil investment on the capex on the supply side. So after that shale oil bust, I mean, there was a lack of investment from national oil companies, a lot of private sector oil companies. ExxonMobil has put a lot of investment into some of these new discoveries offshore, but overall, the industry just has not put a lot of investment into a lot of new supply. So I think we're going to have supply side problems, capex problems, and a lot of the cheap oil that's like $30, $40, $50 a barrel. I mean, the Saudis can't even really make, they can't fund their government at 30 or 40, probably even $50 a barrel oil anymore.
Yeah, I mean, everything is, it's interesting. We look at oil prices, through time and don't think that they should be affected by inflation, right? The oil price hit its, high in 2008, right? I mean, that was 15 years ago. And everything else, that we buy has gone up in price over the last 15 years. So you look at, when you start to inflation adjust the oil price, look at the ratio of oil prices to M2. It's actually closer to the cheapest levels in history than on the expensive side. And so it just tells me there's plenty of room for the upside in terms of oil price relative to the supply of money. And that's probably what the Saudis and other oil producers are looking at. Like, wait, why should the oil price not go up like everything else with inflation over time? And energy has proven to be, through inflationary periods, one of the best ways, if not, along with precious metals, the best ways to protect your purchasing power, investing in commodities and oil and energy producing companies. And so I think that you're right. I mean, this combination of lack of investment, paired with massive amounts of money printing, is going to be, two of the factors that are powering this super cycle in commodities that I think is only just a few years old now.
Yeah, I agree. It's just started, and there's going to be a lot of volatility along the way, but we're just seeing all these deflationistas and bears talk about how commodity bull market's over. Every time the commodity price gets low, I mean, look at the natural gas price. This is not sustainable. You're going to see, at the current natural gas price in the US, you're going to see a lot of supply come offline in the next couple quarters, 2, 3, 4 quarters. A lot of supply is going to come offline if prices stay at these levels. The producers are not going to make investments, and then you're going to see the natural gas price rally after that once a lot of supply comes offline.
Well, they say generals like to fight the last war. And I think investors who went through the GFC, are looking back to that and going, wow, look at what the oil price did in 2008-9. I mean, it absolutely cratered. And it actually put in a major long-term top at that time. Now, and so people are thinking, if we go into recession again, oil price is going to do the same thing. But look back to the cycle before that, right? Oil price bottomed in 2000, 2001-ish, and went on a tear, from that 2002 to 2008 timeframe. And it was the same thing because there had been such lack of investment. There was such heavy investment in the 90s in technology and in all these internet stocks and, and laying fiber optic cable and all this stuff. And the energy sector was left for dead. And so I think you have to look back, not to the last war, but you have to look to previous cycles to understand we're much more similar to that 2001-2 timeframe than we are to the 2008-9 timeframe.
That's a good comparison because that time frame you described, the Chinese demand was just really starting. So there was a ton of new demand coming online from China. And yeah, people aren't the majority of people in China aren't going to be driving these giant sport utility vehicles, these SUVs. But if they're driving scooters and motorcycles and anything that requires diesel or a gas tank, even if it's a small motorcycle or a little biped or a scooter, that's still an enormous increase from billions of people in new energy demand.
Yeah. And there's not, what happened after 2008-9 was the frackers, invested massively in new supplies. And there's not another new technology that's going to come along that's going to allow us to produce a bunch more fossil fuels to meet that demand. It's just, that's not going to repeat. And so, in fact, it's going the other direction. You look at what's going on in the Permian, and it looks like, they're running out of good wells. Supplies are just not going to be there.
Well, I think there is some supply, but we're talking much higher price floors. So we're looking at like $70, $80, $90 a barrel and that new supply. So whether it's oil sands in Canada growing or deep water offshore oil production, I mean, that stuff's not economic at $30, $40, $50 a barrel. We're going to have new higher highs, higher lows, higher price floors for commodities for that oil production to stay economic, to replace the cheaper oil production that's not producing anymore.
Yeah. Well, just look back to a year ago, right? Oil prices went to $120, $130 a barrel, and there was no supply response, right? I mean, that should tell you all you need to know. That, okay, well, where does the oil price need to go then? It needs to go higher than that. We need to see record highs in oil price. You need maybe $150. $175 a barrel.
I think it needs to stay in triple digits for longer than 6 months or a year. I mean, it's the investment required to bring on all these deep water offshore wells for ExxonMobil with the Guyana discovery and Hess Oil down there. I mean, it's going to take more than 6 months or even 12 months to increase production massively. So the average person doesn't understand this. It takes years sometimes and many billions of dollars in capex to bring on a lot of oil production.
And you're absolutely right. And it comes right back to what you were talking about earlier, which is that capital cycle, right? Before this super cycle of commodities is over, it's going to take a bunch of new money coming into the sector, investing in new supplies before you're going to get, really see an important top in commodity prices. We're nowhere near that, right? There's no interest in investing in oil or precious metal mining or any of these things. There's no capital flowing into the sector yet, which tells you you're nowhere near the top in these bull markets.
I 100% agree. And the other problem is a lot of these banks don't want to make investments into the mining companies unless there's like some type of sponsored or subsidy for ESG for a copper mine or something like that. But we're not seeing it. So you're seeing these politicians and bureaucrats and regulators talk about how they want to switch the fleet of cars in California or another state or the country wide from internal combustion engine vehicles over to electric vehicles. Well, no one's talking about the amount of copper that's required and what copper prices and all the new copper supply that's going to be needed to be brought online to replace the copper production in the old copper mines. So if anyone actually does the math, I mean, we'd need way more copper supply and we'd be talking probably over $6 a pound copper. And it would take 10, 15, 20 years probably at least to bring that much new supply online if we're going to switch a lot of our vehicles over to electric vehicles. And then that's not even the energy side. That's just for copper. This for one metal.
I was going to say, not to mention the energy, power generation needed to meet all that demand.
Yeah, it's just a mess. I mean, there's not enough silver, copper, lithium, rare earth elements, and then the energy to switch over to electric vehicles cheaply and easily. The other thing is these electric vehicles, Jesse, I mean, to reduce the weight of the vehicle, they're using a lot of plastic, which is still, last time I checked, a petroleum product.
Yeah. Well, and so, I read an article recently and they showed that essentially, these larger electric vehicles that are now being produced have, literally zero environmental benefit, even over their entire lifetime, over smaller combustion engine vehicles. And so, you end up undoing all the good effects by, building very large electric vehicles, and then when you, add in these other problems and things, it ends up being chasing your tail.
I call it a government boondoggle.
Yeah.
So it's the crowd here in DC, it's all they talk about. I mean, even the Republicans, a lot of them are starting to talk about this stuff. It's just ESG want to transition to this stuff, but it just seems like a new scam. I call it the energy spending grift for DC to spend more and then to steal or siphon off more. It, as you described, it just doesn't sound that efficient. And then the plans aren't made that we have all the copper supply we need to switch over the vehicles. None of these plans are being made in stages. No one's thinking about any of this. You just have a politician saying we're going to ban all internal combustion engine vehicles, and no one's talking about that we need all this supply of metals to make the vehicles to switch over.
Yeah, well, it's a reason why, humanity over, decades and centuries has generally moved towards favoring free markets, because free markets usually make these kinds of evolutionary processes much more efficiently than, as you say, bureaucrats do, because, all of the planning and things that need to happen, you might need to make things a lot more expensive than they are today in order to make them, worthwhile. And that's maybe where we're going to get, where you get, extremely expensive, fossil fuels. And really, if you're an environmentalist and you want to see a transition, you should really be hoping for very high energy prices and make them, uneconomic, so that it makes electric vehicles and things look more economically promising. And so, it'll be interesting to see how it all plays out.
Yeah, I was just thinking about copper mines. I mean, even for a medium-sized copper mine now, it's over $1 billion. And that was when interest rates were cheaper. I mean, now with the higher cost of capital and the higher interest rates, you're looking at billions of dollars to bring on kind of a small copper mine. And that's not going to replace all the copper mines that are being depleted now in Chile and the major copper mines that have been producing for 50, 80, 100 years. So this is a train wreck coming with the super cycle. I want to thank you so much for your time, Jesse, today. If my listeners want to take a look at your newsletter, the Felder Report, or your podcast, or follow you on Twitter, how did they do so?
Yeah, it's my website. It's just thefelderreport.com. And I try and put up a blog post there once a week. And I'm pretty active on Twitter. My handle there is at Jesse Felder. And, every day I try and publish or, tweet several articles, charts, things that I find that are interesting, and just kind of put it out there into the cyberverse. And I think it helps, create these kinds of discussions and figure out what's really going on.
I really enjoy your Twitter. You're actually the only one talking about the budget deficits blowing in. I mean, that's not the spin here in DC. If you watch the mainstream news, they're just talking about how Social Security is underfunded and they need to fix it and they need to figure out how to spend more or tax people more or this stuff right now. No one's talking about the budget deficit problem. That to me signals the Fed's going to have to do something about it at some point.
Well, the budget deficit is something that people have been warning about for a long time. Pete Peterson is one, who's created a foundation. Stan Druckenmiller actually went on to a college tour several years ago talking about this problem, saying we're going to hit a wall, in the next few years. And nobody seems to care. I wrote about it this weekend. I think that it's almost like telling a child, warning a child about the boogeyman. If you don't behave well, you don't go to sleep, you don't eat your vegetables, the boogeyman's going to come get you, right? And there's a reason why this is a cultural phenomenon that trying to transcend cultures, is because while there is no real boogeyman, of course, there are consequences for bad behavior, right? And so the boogeyman is really just a metaphor for those consequences. But a lot of people have learned, like, okay, the boogeyman's going to get me. Great, thanks. And I think that's how people hear these warnings about the trajectory of fiscal policy. And they go, oh, great, the boogeyman's going to get me. But that doesn't mean there aren't consequences that are coming. And I think the consequences, are coming. Paul Singer was gave a great interview in the Wall Street Journal last weekend about this topic, and he says we're very, very close to a tipping point in fiscal and monetary policy, to where we're basically on a runaway train. He didn't use that term, but I think he did use the term debt spiral. And so when you have people like Stan Druckenmiller, Paul Singer, and a lot of these guys warning about this, it's easy to dismiss it because it does feel kind of like the boogeyman. But I think we're getting close to those consequences. And to me, the way you look and see how closer are we to those consequences materializing, it's watch the budget deficit watch the treasury market, because these problems are going to materialize in these areas. And I think we're really close to seeing them materialize, in a way that is possibly pretty dramatic.
The other part of that is that people look at currency exchange rates and people see that the dollar has relative strength. So it's misleading then, because it looks like all these other governments have similar government debt crises. So we could see not just the US. I mean, Japan has problems, European Union, Bank of England, emerging markets with a strong dollar because they borrowed more dollar denominated debt 18 months ago when the dollar was weak. So foreign governments and foreign corporations and emerging markets borrowed even more dollars. So, I mean, this is unfortunately, this looks like a government debt train wreck, and it's not just the US. It's most of these governments now.
Yeah, I think it matters most for the U.S. because the dollar is obviously the global reserve currency, and so the Fed is essentially the world's central bank. And so, I think it matters a lot more to what's going on here. And so, I'm keeping a close eye on it.